All right, let's talk retirement, but we're going way beyond the usual 401k chat. Today, we're looking at two really powerful, kind of advanced tools. They solve two totally different problems on your retirement journey. One is all about building up a massive nest egg, fast. The other, it's about making absolutely sure that money lasts, well, as long as you do. So, let's dive right in. Okay, so first things first, we've got to talk about what I call the longevity problem. We tend to think of retirement as this finish line, but it's not. For a lot of us, it's a whole new chapter that could last 20, 30, maybe even more years. And that, right there, presents a massive financial puzzle, what I call the 30-year question. And that question really just boils down to one simple, kind of scary thing. Will your money outlive you, or are you going to outlive your money? I mean, that's the core anxiety for pretty much anyone planning for the future, right? And for very, very good reason.
And here's a stat that really highlights a huge flaw in how most people plan. A 65-year-old man has a 15% chance of living to 95 or even older. Think about that. If you only plan for an average lifespan, you're literally flipping a coin on whether you'll run out of money. It's a 50-50 shot. That is a gamble you really, really don't want to lose.
This is exactly what the pros call longevity risk. It's the very real danger that you outlive your savings, forcing you to drastically cut your standard of living in your later years. When you're most vulnerable, and heading back to the office just isn't happening. Honestly, this is one of the toughest nuts to crack in all of personal finance.
All right, so let's break this down into two phases. First up, phase one, the accumulation years. This is all about building that nest egg. And for those high earners out there who feel like you've hit a wall with your savings, well, there's a tool that can basically put your savings plan on rocket fuel.
So you're maxing out your 401k every single year? Awesome. But it can feel like you've hit your limit, right? Well, what if you could save way more than your 401k allows? I mean, much more. That's exactly where something called a cash balance plan comes into play. Just look at the difference here. With a 401k, even if you're over 50 and doing the catch-up contributions, you're probably capped at around 30 grand a year. But a cash balance plan, we're talking well over $100,000 a year, sometimes way more. It's not just an improvement, it is a total game changer for anyone trying to supercharge their savings. So how on earth does this work? Well, think of the cash balance plan as a kind of hybrid. On one hand, you get a statement that looks like your own personal 401k account, but underneath, it actually works more like an old school pension. And here's the key difference. The employer takes on the investment risk, not you. The plan promises a set rate of return, which makes the whole thing way more predictable for you. So who is this for? It's really tailor-made for high-earning business owners. We're talking physicians, attorneys, successful consultants, folks who want to put away a ton of money, get a massive tax deduction, and maybe play catch-up on savings after pouring everything into their business for years. It can also be a great way for a business to attract and keep those top-tier employees. Okay, so you've used a tool like that to build your savings mountain. Awesome. But now comes phase two, the decumulation years. This is the flip side of the coin. The challenge now is making that pile of money last for, well, who knows how long. And that requires a completely different kind of tool. And our second tool is designed to solve exactly that problem. It's called a QLAC, a Qualifying Longevity Annuity Contract. And as the American Academy of Actuaries puts it, a QLAC is all about taking the guesswork out of your planning. It tackles that nagging, what if I live to be 100 question head on. So what in the world is a QLAC? The absolute best way to think about it is longevity insurance. It's simple, really. You take a piece of your retirement savings, you give it to an insurance company, and in exchange, they promise to give you a paycheck every single month for the rest of your life. But here's the twist. That paycheck doesn't start right away. It kicks in way down the road, at an age like 80 or 85. And this is where you see the magic. Check out these numbers. If you wanted to buy a guaranteed $1,000 a month paycheck starting right when you retire at 65, it would cost you nearly $200,000. But if you're willing to wait for that same exact paycheck to start at age 85, the cost plummets to just $36,000. It's so much cheaper because you're only insuring against that tail end risk of living a super long time. And the practical benefit here is just brilliant. Think about it. Once you buy a QLAC, you've basically pre-solved the money problem for your 85 or 90-year-old self. That income is guaranteed. So suddenly, you don't have to worry about making your nest egg last forever. You only have to make it last for a fixed amount of time, from retirement until, say, age 85. This gives you the freedom, the confidence to actually spend and enjoy your money in those early, more active retirement years without that fear of running out. Okay,
So we've got these two very different tools, one for building wealth, one for protecting it. So how do they actually fit together in a real-world strategy?
So let's just put it all together. The cash balance plan, that's your accumulation tool. It's for people in their peak earning years, especially business owners who need to ramp up their savings in a big, tax-smart way. And the QLAC? That's your protection tool. That's for when you're at or near retirement and you want to lock in an income stream for your later years to protect against that longevity risk.
They really do solve two completely different problems on the exact same journey. Here's the best way I can put it. One tool helps you build the mountain of savings. The other one is the safety harness that makes sure you never, ever fall off the other side.
Look, retirement really is a 30-year puzzle. It's not one single event. So the final question to leave you with is this: do you have all the right pieces to solve yours? Thanks so much for joining me.